You ever crack open a company's annual report and just your eyes glaze over, right? It looks like it's written in a totally different language. But here's the thing, hidden inside all that jargon is a story. It's a story about the company's health, its secrets, even its big plans for the future. And in this explainer, we're going to hand you the detective's magnifying glass to read it. Because that's really what this is all about, becoming a financial detective and uncovering the real story behind the numbers. By the time we're done here, you'll have a framework, a toolkit you can use to look at any company's financials and piece together all the clues to figure out what's really going on. Okay, so let's get into it. Every detective needs their kit, right? And for us, that kit has three absolutely essential documents: the balance sheet, the income statement, and the statement of cash flows. You need all three to see the complete picture. First up, we've got the balance sheet. The best way to think about this is like a financial photograph. It's a snapshot. It captures everything a company owns and owes, but just for a single, specific moment in time. It's static, but it's a perfect baseline of where the company stands. Now, if the balance sheet is the photo, then the income statement, well, that's the movie. This shows you the action. It tracks the company's performance over a whole period, like a quarter or year. It tells the story of how they took in money, spent money, and whether they ended up with a profit or a loss. And finally, we have the ultimate fact checker, the statement of cash flows. Look, profit can be a fuzzy accounting concept sometimes, but cash is real. This statement is the detective's best friend because it follows the actual money. It shows you exactly where the cash came from and where it went. No estimates, no funny business. All right, let's start our investigation with the first piece of evidence you'll find on the balance sheet: a company's assets. Now, you might think valuing what a company owns is pretty simple, but as you're about to see, it's not that straightforward. And right away, we run into this fundamental conflict. On one hand, you have historical cost. That's what the company originally paid for an asset. Accountants love this because it's a hard, objective number. But on the other hand, you have market value, what that same asset is actually worth today. That's what investors usually care about, but it can be subjective and change all the time.
This quote really gets to the heart of the accountant's mindset. There's this deep-seated belief that market value is just too flimsy, too easy to manipulate. So as a detective, you've got to remember, almost every number you see for an asset is based on what it cost way back when, not what it's worth right now.
So let's get our hands dirty with a real-world case file. We're looking at two very different companies: RTX, a huge conglomerate, and Home Depot, the retailer. Just let your eyes scan the numbers. See any clues that just jump off the page? How about that goodwill line for RTX? It's over $53 billion. That's a third of their total assets. What on earth is that? Okay, so goodwill is basically a placeholder for all the stuff you can't touch when one company buys another. Think brand reputation, customer relationships, that kind of thing. That massive $53 billion number tells us a huge part of RTX's story. It has grown by buying up a ton of other companies. It's also one of the fuzziest, most subjective things on the entire balance sheet. And here's another juicy clue, often hidden away in the footnotes: how a company values its inventory. Let's say prices are rising. If a company uses LIFO, or last in, first out, they're pretending they sold their newest, most expensive inventory first. The result? The reported profit looks smaller, which, and here's the kicker, means they pay a smaller tax bill. A simple accounting choice totally changes the story. Okay, so we've dug into what a company owns. Now let's flip the coin and look at the other side of the balance sheet. This is where we investigate who actually has a claim on all those assets. It's the story of how the company is financed. So, who gets a piece of the pie? Well, first in line are liabilities. This is all the money the company owes to lenders, suppliers, you name it. And then, whatever is left over after all those debts are paid off, that's shareholder equity. It's what the owners, the shareholders, actually have a claim to. And whoa, here's another major clue. Check out the bottom of this table. Home Depot's total equity is tiny, just $1.5 billion. But then look one line up. What is that massive negative $87 billion in treasury stock? What is going on here? Here's the solution to the puzzle. Treasury stock is just the company's own stock that it has bought back from the market. Home Depot has spent an absolute fortune buying back its own shares. Now, this is a way to return cash to shareholders, but it also creates this huge negative number that wipes out the book value of its equity. It's a strategic choice, not a red flag. So the balance sheet gave us that snapshot in time, but now we need to press play on the movie, the income statement, to get to the final verdict. Is this company actually any good at making money? And here you can really see their different business models at work. I mean, Home Depot's revenue is more than double RTX's, and it's just incredibly good at turning those sales into actual profit. You can see it right there in the operating income. It's almost 7 times higher than RTX's. That tells you its core business is a money-making machine. Now, to really, truly judge how good a company is at its job, financial detectives use a killer metric called return on capital, or ROC. This little tool cuts through all the accounting noise and asks one beautifully simple question. For every single dollar we've invested in this business, how much profit does it spit out? And boom, here it is, the final verdict. RTX generated a respectable 7.6% return. Not bad. But Home Depot, a stunning, jaw-dropping 62.8%. Think about that for a second. It has less capital invested in its business than RTX, but it is monumentally more efficient at generating profits. That is the real story the numbers tell. So, case cracked. Let's quickly recap the key principles we've uncovered, so you can add them to your own financial detective's handbook. Keep this little handbook in mind. Remember, the balance sheet is the photo, the income statement is the movie. You need both. Always be a little skeptical of those fuzzy numbers like goodwill. Understand that simple accounting choices can totally change the results. And please, use ratios like return on capital to get to the real truth about how efficient a business is. So the next time you look at a company's financial report, you won't just see a wall of numbers. You'll see clues. You'll have the toolkit you need to start asking the right questions and piecing together the real story. So the only question left is, what case are you going to crack first?